So what's the one thing that separates a brilliant business from one that goes bankrupt? Or, a really savvy investor from just a gambler? Well, it's not always about being right. It's about having enough room to be wrong. And today, we're going to talk all about that room, that critical concept known as the margin of safety. It's the financial buffer that protects us from a world we just can't predict. Let's dig in and figure out exactly what it is, and, more importantly, how to build one.
Well, hello there. I'm Gemini.
Warren Buffett has this incredible knack for making really complex ideas sound so simple, and his take on this is just perfect. Think about it. A bridge engineer would never, ever design a bridge to hold exactly the weight of the trucks crossing it. I mean, that would be totally insane, right? Now, they build in a massive buffer. And that buffer, that's the margin of safety. It's this powerful admission that, hey, things are going to go wrong. Forecasts are off, markets get crazy, and sometimes you just have bad luck. This isn't about being optimistic. It's about being realistic and building in resilience. Okay, so here's our game plan. We're going to start with the basics. What exactly is a safety margin? Then we'll look at how it plays out in two totally different arenas, running a business versus picking an investment. We'll even get our hands dirty and actually calculate one. After that, we'll look at some real strategies for making that margin bigger, and we'll wrap it all up by seeing this as more than just a number. It's really a philosophy for making smarter financial decisions.
All right, first things first. What exactly is this financial cushion we're talking about? It's a fascinating idea because it isn't just one single thing. It's kind of like a chameleon, It changes its meaning depending on whether you're standing in a factory or on Wall Street.
At its absolute heart, the margin of safety is just the distance between where you are right now and the danger zone. Think of it like this. For a business, the danger zone is that break-even point, that scary moment where you're not making money, but you're not losing it either. For an investor, the danger is overpaying, paying a price for a stock that's way higher than what the business is actually worth. It's all about that gap.
And this is where the concept really splits in two. On the business side of things, it's all about the numbers. It's a precise calculation that tells a CEO exactly how far their sales can drop before the company starts bleeding red ink. But on the investing side, it's much less of a science and way more of an art. It's a guiding principle. It's about having the discipline to buy something for less than you think it's truly worth, creating a personal buffer just in case your valuation is, well, wrong. Let's tackle the business side first.
So when we talk about a margin of safety for a business, what we're really talking about is its shock absorber. It's that cushion that lets a company survive a terrible sales month, a sudden spike in costs, or a new competitor trying to eat its lunch, all without immediately plunging into a financial crisis. It's breathing room.
Now, to figure out the size of that shock absorber, we need to get a handle on three core ideas. First up, you've got your fixed costs. These are the bills that show up every single month no matter what. Think rent, insurance, salaries for your key people. Then you have variable costs. These move up and down with your sales, like the cost of raw materials for a factory. The more you sell, the more you spend. And finally, you put those two together to find the break-even point. This is the magic number, the exact sales target you have to hit just to cover all your bills.
Okay, that's enough theory. The best way to really wrap your head around this is to see it in action. So let's roll up our sleeves and walk through a practical example to see exactly how a company calculates its own financial buffer.
It really is a pretty straightforward three-step process. First, you've got to do your homework and separate all your costs into those two big buckets, fixed and variable. Second, you use those numbers to figure out your break-even point. And then finally, you just compare that break-even number to what you're actually selling to find your margin. Let's put this to the test.
To make this super concrete, let's invent a company. We'll call it Widget Co. Now, let's take a peek at their numbers.
Okay, here are the key figures for Widget Co. As you can see, they're doing pretty well. $450,000 in sales. Their fixed costs, so things like rent and admin salaries, are a flat $100,000. And their variable costs, the direct cost of making all those widgets, came out to $250,000. So the big question is, with this financial picture, how much of a buffer do they really have?
So how in the world do we get to their break-even point? Well, the math is actually simpler than you might think. We just need to figure out how much profit they make on each dollar of sales after they cover the variable costs, and then see how many of those dollars it takes to cover the fixed costs. In this case, their variable costs are about 55% of sales. That means for every dollar they sell, they've got about 45 cents left over to pay for fixed costs. So to cover $100,000 of fixed costs, they need to sell $225,000 worth of widgets. That's it. That's the break-even point. It means the first $225,000 they make is just to keep the lights on. Every single dollar above that is pure profit.
And that brings us to the final, really powerful result.
We take their actual sales, 450K, and we subtract the break-even sales of 225K. The difference, that safe part, is 225K. Then you just divide that safety buffer by their total sales, and boom, you get the answer. Widget Co. has a margin of safety of 50%. This tells their leadership something incredibly valuable. They could lose half of their business, literally overnight, and still not be losing money. That is a resilient, healthy business.
Okay, so let's leave the world of accounting spreadsheets and pivot to the much, much murkier world of investing. Here, the margin of safety concept completely transforms. It's no longer a simple calculation. It becomes a philosophy. It's the investor's ultimate shield against the chaos of the market. And, let's be honest, against their own mistakes.
The idea was really born from the ashes of the Great Depression, pioneered by the absolute legend Benjamin Graham. His approach was almost mechanical. He would hunt for what he called cigar butt companies. You know, these terrible businesses that were so ridiculously cheap, you could buy them for less than the cash they had in the bank. You could pick it up off the street and get one last free puff. Then, decades later, his most famous students, Warren Buffett and Charlie Munger, they took that idea and they evolved it. They asked, what if the safety margin isn't just about a cheap price, but about the quality of the business itself, its brand, its competitive power, what they famously called its economic moat?
This table just lays out the two schools of thought perfectly. Graham was laser-focused on the balance sheet. He wanted tangible assets that he could see and count. The actual quality of the business, that was a distant second to just how statistically cheap it was. For Buffett and Munger, the quality of the business is everything. They want to understand its long-term earning power and its competitive strength first and foremost. The price has to be fair, of course, but their whole mantra is quality first, price second. It's two very different roads that ultimately lead to the same destination, protecting your capital from permanent loss.
So, what does this actually mean for an investor in practice? Well, the principle is deceptively simple, even if the execution is incredibly hard. You have to do the work to estimate a business's intrinsic value, which is basically the present value of all the cash it's going to generate for its owners for the rest of its life. Then, you have to have the patience to wait until the market, in one of its crazy moods, offers it to you at a significant discount to that value. That discount is your margin of safety. And as a rule of thumb, a lot of seasoned value investors won't even look at a stock unless they can buy it for at least 20 to 30% less than what they think it's truly worth.
So knowing your number is a great first step. But the real question is, what can you actually do about it? How do you increase your buffer? Let's move from theory into action and look at the levers you can actually pull, whether you're running a company or just managing your own portfolio.
To see why this matters so much, let's look at another quick example. After a huge new equipment purchase, Ford's margin of safety was calculated to be just 5.8%. Now compare that to the 50% we just found for our imaginary Widget Co. What does this tell you? It tells you Ford is operating on a razor's edge. A tiny dip in car sales could make that entire massive investment a money loser. Widget Co., on the other hand, can weather a pretty big storm. A high margin isn't just a number on a spreadsheet. It's a real sign of operational resilience.
So, if you were the CEO of a company with a dangerously thin margin, what could you do? Well, there are really four main levers to pull. You can attack your costs, you can look at your pricing, you can focus on sales volume, or you can get really strategic with your product mix. Now, what about for an investor? The levers are different. To increase your margin of safety, you can deepen your research to get a more accurate estimate of a company's real value. You can exercise extreme patience, waiting for a market panic to give you a better price. And you can focus your search on only the highest quality businesses, where the safety is practically built right into the company's competitive advantages. As we start to wrap this up, it is so important to see that the margin of safety isn't just a formula or a ratio you calculate. It's a mindset. It's a whole philosophy of prudence that really applies to all financial decision-making. Benjamin Graham himself argued that the real key to success wasn't being the smartest person in the room. Nope. It was about having the right temperament, the emotional discipline to build a solid framework and then actually stick to it when everyone else is either panicking or getting greedy. And the margin of safety is the cornerstone of that framework. It's like an automated defense against your own emotions. It forces you to be humble, to admit you don't know the future, and to demand a discount to protect yourself from that very uncertainty.
So if you take one thing away from all of this, let it be this. The margin of safety is a profound acknowledgement that the future is unknowable. It's a practical tool for building resilience into your business, your investments, and maybe even your personal finances. It forces you to stop asking, what do I think will happen, and to start asking a much, much more important question. What happens if I'm wrong? So how big is your buffer?